Okay, Guilherme, I think we should start. Thank you everyone for attending this webinar. Today we have here Guilherme Salgueiro, who is the head of alternative investment for BTG Pactual US. And today we are presenting a private debt investment opportunity with Madison Realty Capital through a BTG Pactual investment fund. Today we're covering the strategy, the GP partner, and how we are implementing this investment opportunity for all our clients. Guilherme has extensive experience across the alternative investment in all asset classes, venture capital, private equity, private debt, real assets, as well as liquid alts in Brazil, but also abroad. And I think today we have a really good opportunity to hear from someone based in New York how to play, I would say, a safe investment for the next years, considering the potential economic activity, the below trend growth that the American economy is facing in the next 2 to 3 years. And interest rate are giving us a good entry opportunity, and maybe the best way to do that is to play it in a private investment vehicle. So Guilherme, the screen and all of the audience is yours. Please let us know, everyone, if you have any questions. You can use the Q&A tools in the Zoom. I think we're in Zoom. Yes, in the Zoom tools. And that's it. Guilherme, thank you.
Thank you, Mauro, for the introduction. It's a pleasure to be here. Thank you all for being connected and for your time. I've been at the bank since 2009. In 2009, I'm based in New York, and we've had previous discussions with some of our investors in Chile. So as you know, we have two big mandates in alternatives offshore. One is building alternative portfolios for our clients and partners. So we invest across the risk spectrum, from hedge funds towards passing through private debt, real estate, private equity, and venture capital. We have a second, and I would say most important mandate, which is manager selection across all these asset classes. Our proposition is an active portfolio proposition. All these managers are looking to generate alpha in their specific areas. The benefit of a capital allocator in these asset classes is that the farther you go in the risk spectrum, the largest is the return dispersion across managers. So when we have the ability to identify top managers and in the majority of the situation have access, and the majority of the situations, the most difficult aspect of what we do is building these relationships and having access to these managers, the opportunity to generate alpha is very interesting. So we are we've been working here to position our platform in a very strategic manner, using BTG's local presence in Latin to establish these relationships with managers is an interesting dynamic where we're performing due diligence, but on the other hand, they are getting to know who is BTG Pactual, whether we are value add capital that we can bring to the table. We can help them with any project or interest in different industry they might have in Latin America. And with that, we've been able to have access to some of the most competitive, difficult situations. Madison is another example where we are the sole investor in Latin America, and we'll discuss a bit more who is invested alongside us. So we're pretty excited. Moving forward, executive summary here. I think the background is very interesting in private debt, especially on the hard asset lending side, especially on the real estate side. We've seen for the past 10 years, I would say after 2008, the growth in private debt markets from both a corporate side. If you look at the corporate credit market, high yield bonds market today is $1.5 trillion, and it's been somewhat stable or growing slowly in recent years. The loan market has grown a bit quicker, but it's about $1.4 trillion. The market that has grown the most is direct lending for corporates, from basically $100 billion to today $1.3 billion. And on the hard asset lending side, on the real estate market, we've seen a very similar dynamic, and it basically started after 2008. The center of the crisis was the US financial system. After the crisis, the regulatory response was as intense as the crisis. So in 2009 and 2010 and 11, basically Dodd-Frank made it very difficult for banks to participate in risky new investments. And basically we've seen growth in these private markets, private capital allocators being able to take advantage of opportunities that before were basically taken by banks' balance sheets. So that background is very interesting because we can find, it's very simple, we can find interesting yields, high yields with low intrinsic risk. It's all about getting an appropriate yield, very interesting yield in comparison to what we see in public markets, with a very limited low intrinsic risk. That's what makes the opportunity interesting at the end of the day. We're talking about Madison today. Madison is a manager that was founded in 2004. I will go through the presentation, and we can go back and forth here today. And by the way, Mauro and everyone, please feel free to interrupt me with questions. Madison was founded in 2004. Three actually childhood friends from Brooklyn, from the Jewish community in Brooklyn. They've had significant experience in the real estate market until 2004 when they launched Madison. Josh Zan, here on the left-hand side, he's responsible for origination, loan origination. He worked for many years at Salomon and then Merrill Lynch. Brian is responsible for asset management, all the invested asset management and all aspects related to that. He worked at Blackford before launching Madison, and Adam is responsible for all activities non-related to investments. So basically, they were founded in 2004, and what is interesting is that they launched their first fund in 2005, before the crisis, and that's very important. I'll get to that. The first fund was supposed to be liquidated starting in 2008, and then came the biggest crisis in the real estate market, basically in history. And it was very interesting because Madison was one of the very few managers that managed to protect capital during this period. The returns for Fund 1 were basically 1x multiple, or close to zero annualized net return, which is basically very solid for that period. And it's when we perform due diligence, it's very hard for us to find a peer group from those years, because basically the majority of managers had very negative performance, had to close their fund, and so on and so forth. And what is interesting is that after that, they created a joint venture to capture the distressed market. And after that, they've been very consistently delivering top quartile returns. But I would mention, as you see here on page 7, the vertically integrated platform. That was key for Madison, not only to protect capital in the worst crisis that we've seen in real estate markets, but also to build a reputation. At the end of the day, the vertically integrated platform means that Madison is lending on a hard asset, but it means that they have the capabilities internally, in case of default, to take that asset, run the project, and basically execute, make the sale. So that not only gives us additional lines of defense in terms of the intrinsic risk that we're taking, which basically reduces our intrinsic risk in the portfolio, in the investment, but more than that, creates the reputation and basically puts Madison in a very strong reputation with sponsors that are basically originating new projects. So fast forward to today, we cannot guarantee if any sponsor taking a project from scratch, from initiating a new project, will have the first call to Madison in New York or in California, but we know Madison is going to be one of the first 5 or 10 calls. And why is that? Because there are very few managers in the US with this vertically integrated platform that Madison brings to the table. So all the experience and all these years, almost 20 years in the market, puts them in a very, very interesting position. So basically, getting back to page 6, they've been generating 11% IRRs, net IRRs since 2005, with more than $20 billion in transactions, more than 500 different deals, top quartile returns. It's very interesting. As I mentioned in the beginning of the conversation, this market has been growing in recent years. We see a number of new managers in this space, and that's natural. The market has been growing, the opportunity grows, and basically managers chase that opportunity to allocate capital. When we invest in real estate debt, which is the strategy here that we're discussing today, today we're discussing about value add, bridge loans, senior loans, short duration, float rating, conservatively leveraged. The LTV on average has been ranging from 60 to 65. So today we're talking about a senior, somewhat conservative real estate debt strategy. But when we discuss about real estate debt or real estate equity, the first question we make ourselves during the due diligence process is where the team was in 2008. Mauro, I'm not sure how long this cycle evolves. The real estate cycle evolves in Chile, but in Brazil, for instance, the investment cycles in real estate are very short. Like every 3, 4, 5 years, you have a crisis or you have interest rates, local interest rates going up, and then valuations decline and the market shakes. In the US, cycles are very long. And actually, in real estate, since 2010, we've only seen good news. And specifically in the past 2-3 years, news were very, very good, given all the fiscal stimulus and the monetary stimulus we've seen in the market. So, like we make this comment when we discuss with investors: watch out for managers in that space that are going with their first or second or third vintages. It's very important to have experience across different cycles and to have experience solving problems, because risk at the end of the day is not generally in the majority of situations is not risks that you can that you know already. The unknown are basically where basically you can get hurt in the majority of investments. So having managers that have this experience across different cycles, that have this vertically integrated platform to solve problems if they occur, is very, very important. So, and that's why Madison has been able to deliver consistently top quartile returns and building diversified portfolios across different geographies in the US, across different sectors, mostly multifamily, mostly residential, which we've seen through COVID has been a very robust and consistent sector in real estate. Rent collection across this area wasn't below 90%, 90, even in the worst times of COVID. And an area that has been growing a lot in Madison's portfolio is logistics. Basically, all this deglobalization team, this re-onshoring team, companies bringing their supply chains back to local markets, have been having a positive impact in the logistics industrial real estate sector. So Madison is well positioned to capture that, and also offices. As I mentioned, very, very experienced team. I have to mention that Madison 2 months ago entered into a strategic partnership with Iconic. Some of you may know Iconic is the largest multifamily office in California. They run capital for Mark Zuckerberg, Jack Dorsey, Microsoft's CEO, and other prominent investors and entrepreneurs in California. They invest directly into venture capital companies, but for other asset classes, they allocate for their clients through funds like we do. And their largest investment in real estate debt is with Madison. They have more than $1 billion invested with Madison. And 2 months ago, basically, they decided to acquire 10% of the GP. They acquired 10% of the company, which is great for us, and just shows how solid is their reputation. So I would say that, in summary, when we look when we're looking for a new investment in this area, it was very clear when we analyzed Madison's track record, but more than that, their reputation today, they are in a unique position to continue to generate the type of returns that they did in the past. And in our due diligence process, the main thing that we're looking for is visibility. We need to have the visibility that the current market position that Madison has, they're in a good position to continue to originate the loans and produce the returns that they did in the past. And all the platforms that I mentioned, all the sponsors, all loans that Madison originates, Madison is the sole lender. So basically, these are situations where Madison is not competing in syndicates. Madison is not competing in syndicates or not investing in mezanine debt like we see other funds do. So in summary, what we see here is an opportunity for us to generate very interesting returns, risk-adjusted returns. When we make long-term investments, we always compare the type of return that we can make in public markets versus public markets. And we are aiming here to deliver something between 10 to 13% net annualized return for intrinsic risk that when we try to compare to public markets, it's not equivalent to investment grade, it's not equivalent to high yield, it's something in the between. So today, if you make a high risk allocation, this would yield something between 5 to 5.25. So we are aiming here from 10 to 13%. The manager has delivered 11% annualized. So we have a very interesting reward for the liquidity, given the high yield and the low intrinsic risk, in our opinion. So I think that's an interesting way to point out. We have here a BTG overview in the presentation, and why is that? And I'll get back to this summary for a minute. We've managed to have access to Madison's Fund 5. We are now invested in Fund 6. 2 years ago, we were the first Latin American investor with a meaningful allocation in the fund. We allocated $40 million to our clients. We've been very impressed with them so far. During that period, actually, we've been invested in Fund 5 for 18 months, 16 months. The fund has been running around 11% annualized. In that period, liquid fixed income has had a very, very tough environment. So for Fund 6, Fund 5, by the way, is 60% called and 95% committed. For Fund 6, we wanted to increase our allocation. And in parallel to that, we brought the head of real estate for BTG. His name is Michel Wurman, senior partner at the bank. He's based in Brazil. He runs a portfolio that is around $5 billion in Brazilian real estate. We have some exposure to LATAM outside Brazil and some exposure to Portugal. And discussing with him, I basically introduced him to a number of managers that we have here in the US, in New York. And when he met Madison Partners, it was very clear for him that we should have a strategic relationship and a strategic engagement with them. So what we negotiated was a larger allocation, $150 million allocation, in exchange for 2 seats in the advisory committee of the fund. The senior partners of the bank at BTG loved the idea. So what we have today in this fund, BTG is allocating $150 million. So it's our largest investment in private debt in the year. Out of that, $50 million is basically for the bank, and we're allocating $100 million for clients. It is very interesting because we will have a seat in the advisory committee for the fund, so we'll be very close to Madison. Alongside us will be Abu Dhabi Investment Authority. Abu Dhabi Investment Authority, ADIA, is the sovereign wealth fund for Abu Dhabi. They're investing $500 million in the fund. Iconic, I mentioned, is investing several $100 million in the fund. Texas Permanent School, which is a $60 billion pension fund, and 2 or 3 other institutional investors, one of the 2 largest Canadian pension funds. So it's a very institutional investor base. The investor base that actually has been following Madison for many years. So for us, it's just a great opportunity, first, to allocate, have this $100 million allocation to our clients in Brazil, Chile, Colombia, Peru, Mexico, and also for the bank to have this allocation for the bank's balance sheet, and also for Michelle Wurman, which is the head of real estate at the bank, to be close to the manager, and we believe that not only for this fund, but in the future we'll have future opportunities to collaborate with them. So that's why it's a BTG fund. So we have this section here that I think you are well known, you know it pretty well. As I mentioned, Madison has more than $20 billion in transactions. The equity investments that you see here is basically the period during the crisis where they took advantage of their integrated platform to take advantage of a distressed market. And as I mentioned, today they're running a bit above $8 billion in in assets, more than 500 transactions over history. So again, today it's somewhat common for us to see different managers coming out with new real estate debt funds. Again, we are always looking towards the firm's experience, track record, experience innovate, the capabilities in the platform, whether they can handle difficult situations or not. And again, what we see in Madison is unique, and that's why they have such an institutional investor base in their platform. I mentioned about the team. Again, they have today, they're getting close to 80 people in the team, and they have all the capabilities to run assets from a debt or equity perspective in-house. They're based here in New York, a block from us on Madison and 54. It's interesting, as I mentioned, I was mentioning about some of their investors, a very institutional investor base. Latin America here, Mauro, the 1% is us, and I think it's going to 2% or 3% now with our allocation in Fund 6. I would jump into the portfolio for us to discuss in greater details. So the portfolio is first of all, very importantly, is diversified. Every fund that Madison launches has a 4-year investment period, and that's by design. And actually, that has been a demand from LPs. Why is that? Because you generate vintage diversification within the fund. So basically, the fund will be originating loans in 2022, 23, 24, and a bit in 25. It's a diversified portfolio in terms of geographies. The New York area will always be a meaningful market. So I would expect at least 25% of the fund to be invested in the New York area. California is an area that is also very important, especially on the logistics side. South California and the greater Los Angeles area, it's a meaningful industrial real estate market, and Madison has been capturing the growth in that market. On the residential side, they've been capturing growth in Sun Belt states. So Florida and Texas, I would expect to represent something between 10 to 20% of the fund. And then the remainder of the fund will be exposed to major metropolitan areas. The fund will be focused in terms of sectors in multifamily. We expect multifamily mixed use to be between 2/3 to 70% of the fund. There are some deals, for instance, Madison 5, the previous fund, was the sole lender for the new Four Seasons in Miami. So that's a hotel, but it's a hotel with a component of apartments. So it's a multifamily component within a hotel that de-risks the whole project. So when they have mixed use here, it's basically majority multifamily. We have retail here, but retail recently has not been an area of focus. Very, very rare situations, premium class A situations that they've done retail in the past 10 years. So the fund's going to be mostly multifamily with some exposure to offices in major areas and industrials. Again, that's an area that has been growing a lot. I mentioned that the globalization and re-onshoring theme has been very positive for this sector. Land is basically a project where there will be a development over that, and the development will probably be multifamily or office. Importantly, the fund has no leverage on the fund level. I will explain that once we understand that aspect of Madison has a very active capital markets team. And they perform an activity that you would usually see in an investment bank. And what basically they do, they originated a loan, and then after that, they sell a portion of the loan. I'll discuss in greater details in a minute. So there is no leverage on the fund level, and they generate leverage on the deal level when they sell the loan that they originated. And I will explain in a bit. In terms of the loan size, it varies a lot. It can vary from $20 to $200 million. In some situations, they've originated loans above $200 million. For them, it's a very interesting way to put it out. Having the flexibility to originate small loans over the years helped them build their reputation, and so that sponsors got to know Madison, and after 1 year or 2 years, when they had a bigger project, they knew they could count on Madison to originate a new loan. So that's interesting. Again, senior loans, short duration, floating rate, a number of covenants. They have all the team in place to guarantee, at the end of the day, the LTV between 6 and 65% is conservative. But for us, the most important thing is their experience in good markets and bad markets. The LTV, it's on paper. At the end of the day, the most important aspect is the manager's judgment. So again, to my point, there are a number of young real estate debt managers in the market, but again, you need the experience, you need that judgment. So when we see this summary again, we are very comfortable with the intrinsic risks that we're taking, and we believe that the type of return that we are looking in comparison to these risks is very, very interesting. I will jump to an important aspect of today's markets. Rates are increasing. These loans are structured as SOFR plus the old LIBOR plus, now it's SOFR plus. It means that you're basically, as nominal rates increase, the total nominal return for this fund we expect to be better than the recent two vintages, funds 4 and 5, where nominal rates, basically the base of the LIBOR base was close to zero, was very low. Now the SOFR base is increasing, and the spreads, given again the market opportunity, this is a market that continues to rely on capital investors, and banks are very limited to access here. So spreads continue to be very interesting. So we believe that the fund is positioned to cope really well with a rising rate environment. We've seen that actually for Fund 5 in the past 16 months has been delivering very good returns in a market that has been very tough for liquid fixed income. This presentation, I'm going through this presentation pretty quickly because we have a lot to cover, but we'll share these materials with everyone. On the leverage side, that's a very important page here in this presentation. So again, vertically integrated platform, Madison originates individually on a exclusive basis most of its loans alongside sponsors, so they don't participate in syndications, and then after they originate these loans, historically between 7 to 12% nominal coupons, depending on the spread market. After they originate the loan, the capital structure is very strong. It's very strong. So what does Madison do? Given that the capital structure is very strong, they can sell a portion of the loan originated by the fund to a commercial bank. And why a commercial bank would buy this piece of loan? Because basically the LTV after Madison invested is very low. So it's equivalent of an investment grade bond, but Madison pays a bit more than an investment grade bond. So basically what you have here is that Madison is the sole originator of these loans, 7 to 12% coupons. And when they sell these in the market, they sell paying 3 to 5%. And the fund captures all these spread. This spread, for instance, in a corporate bond market is something, it's an activity that an investment bank would capture, for instance. So this is very interesting for us, and that's why they've been able to generate net and low teen returns, investing in short-term senior loans. And again, during 2020, something very interesting happened. A number of funds that, the majority of funds actually, that employs leverage on the fund level, when COVID happened, they were expecting capital calls on some that markdowns, and they were not able to invest. Madison is never exposed to repos or repo accounts or capital calls, basically because there is no leverage on the fund level. So it's again comes back to their platform and experience and reputation in this market. When we see historically, this is a very interesting chart as well. Here we have the nominal yields on loans. As you can see, for the past 7-8 years, nominal yields came from 12, 13, 11 to 13 towards 8, 9. We believe we are getting back to what we've seen 7, 8, 10 years ago, with nominal rates going up, which can be very interesting for us. The LTV has been very consistent over time. So the LTV means something very interesting for us. It's basically the margin of safety. We do not expect a real estate crisis in coming years, but what we've seen in the past 2 to 3 years in real estate markets, we believe was an anticipation of potential returns from the next 2 to 3 years. We had very important fiscal stimulus in the US. We've had a monetary policy that was clearly behind the curve, and the Fed is now working to to cope, is coping with inflation now, and we still have a supply problem. So what we've seen, and I'm sure you've been following that, house prices and the appreciation in multifamily market has been very strong. We believe that these markets will decelerate. We don't expect a crisis, but we believe these markets to decelerate to something between 0 to 5% growth. What does that mean? It means that for private real estate debt, we still have 35% of, on average, of margin of safety here. And we don't expect anything close to 2008 to happen. So our margin of safety is very meaningful. But on the real estate equity side, we're always analyzing different market opportunities. If you are a real estate equity investor, you have to pay attention to, it's a different risk profile. You have all the exposure to the upside of the asset, but you have the exposure to the downside of the asset. On private debt markets, our upside is limited to the yield that we're generating, something between 10 to 13%. That is what we're aiming here. But on the other hand, our risk is way lower. We are at the top of this capital structure, contractual returns, with a big margin of safety. On the real estate equity side, the picture is somewhat different. So we believe that there is a very interesting opportunity on the real estate debt side today. And more than that, Madison, they have the ability not only to originate new loans, but they have the ability to invest opportunistically. So there are a number of projects in the last 2, 3, 4 years, 5 years. As I mentioned, the real estate cycle in the US is very long. So there are a number of projects that were structured with a lot of leverage, 85% LTV, 82% LTV. So when you have a market where the cost of capital is increasing, construction cost is increasing, and the market is decelerating, a number of these projects might need capital. And Madison will be well positioned to basically come with new capital for these projects to continue from a senior position, charging good yields for that. So we believe that the opportunity set for Fund 6, given where we are in the market cycle, could be better than Funds 5 and Funds 4. So when we look here through performance, as I mentioned, the gray area, it's key for their history and their reputation. They protect capital. Multiple on the right-hand side here, the right-hand columns. Multiples that are basically 1 in 2008, and then they created a joint venture that captured the distress process. So during 2008, they've managed to generate very interesting returns. And from Fund 2 on, top quartile returns from a net IRR standpoint, from an equity standpoint. Funds 1 and 2 are fully, and joint venture are fully liquidated. Fund 3 is more than half liquidated. Fund 4 is already more than a third liquidated. So capital comes back very consistently. All of these measures are top quartile returns. To my point, as capital allocators, we want to be rewarded for the active management and the risk that we're taking. And we've been, Madison investors have been well rewarded when we compare to the sector or other credit markets or the liquid credit markets. The gap between these markets has been meaningful. We have here some case studies. I want to save some time for questions. But yeah, we just have here an interesting, yeah.
Maybe you can give us a quick review on what does it mean in this asset class and industry, being vertically integrated company. I know you're aware of that meaning, but maybe you can contrast that feature with the classic private lenders in the market.
Sure, Mauro. That's a good point. So basically, Madison, on the origination side, Madison is the sole lender in these loans. What does that mean? It means that Madison employs all their experience and judgment in determining all the aspects, the legal aspects, the covenants protecting us as investors on the deal. So as an example, they know their local markets, what are the best service providers, what are the expected costs and timeline on these constructions. All these loans, they have covenants protecting us against any setback in the progress of the project. Every dollar that we send to the project, by design, we have to have between $1.50 to $2 protecting us. So that's something that in a traditional real estate debt manager that participates in syndicates, you don't get to put your opinion or to define all the details on the loans. You get a stake on a loan that was already syndicated, and generally risks are higher. Generally, you might have a mezzanine piece, you might have a senior piece on top of you. Another important aspect, Madison has experience with other cycles and with tough markets. So when they write the covenants, when they create the SPVs, basically the special purpose vehicles, every project is a separate entity. They create the wording, the legal terms, in a way that if there is a default, the wording is so clear in the SPV that the New York Southern District judge will take 2 to 3 months to clear all the process and for them to take the asset. That's very unique. And again, another line of defense. In a traditional real estate lender, if there is a default, you might have situations where it takes 1 year to 2 years for you to take that asset. And then that has a big impact in your net IRRs, and it can have a big impact in the duration of your investment. A short-term loan that was supposed to be there from 2 to 3 years, gets stuck in your portfolio for 5, 6, 7 years. So all these somewhat little details make all the difference when something that you don't expect happens. And Mauro, we've been in this market for 20 years plus now. Unexpected things always happen. We know unexpected things will happen. We don't know it's going to be COVID or it's going to be US-China trade war in 2018, or it's going to be oil markets declining 50% in 15, but something unexpected will happen. And for you to have all these capabilities in place, basically, that's what brings us comfort that we have a number line of defenses in this strategy. We are aiming to generate double-digit returns, 10 to 13% analyzed returns, but with low intrinsic risk in this strategy. So I think that's key. And we've seen, again, in the growth of this market, you always see managers trying to chase it. Fund 1, Fund 2, Fund 3, again, watch out to the experience of the team. Where were you in 08? So here we have a few examples. A multifamily project in Florida. This is very interesting. This is mixed-use office and condo in Boston. If you know Boston, that's basically the downtown area. Here was an opportunistic situation. Madison knows a developer that needed cash for one project in Portland, and basically they combined a project in Vegas and a project in Portland, both with known brands that you know. One is Ritz-Carlton, and they basically created a new loan with a high level of guarantees. Again, this opportunistic way of doing business is what brings is where the return comes from. Here in an industrial project, as I mentioned, I expect the logistics sector to represent a bigger portion of the fund. And for us, it's very interesting. These tenants tend to have 10 to 15-year contracts adjusted by inflation. It's the equivalent of having AAA credit, but basically yielding way more. Your tenants are Microsoft, Amazon, and so on and so forth, in most cases. The key terms of the fund. The fund is targeting 2.25. They can get up to $2.5 billion. Top service providers, the usual ones. The management fee for us is not 1.5, is 125. We participated in the first close with $150 million, and every client is getting the 125% fees, which I think is very competitive. The performance fee is basically 20% over a preferred return of 8% annualized with a 50-50% catch up. So I would say very, very competitive terms for us. We created a feeder fund to basically make these allocations to our investor base. As I mentioned, Madison has like a very institutional base. We cannot have a number of LPs. We want our Brazilian, Chilean, Colombian investors to have exposure to this opportunity. So the deal we had with them, like we did for Fund 5, we created a feeder fund. Our feeder fund is allocated $150 million. We will have two share classes, one with a minimum commitment of $100,000. And then we have a management fee of 75 basis points on invested capital. And we have another share class with a minimum commitment of $1 million with a 50 basis point management fee on invested capital. As managers of every feeder that we establish, the goal is to replicate our underlying managers' investment. So basically, we replicate capital calls and we replicate the distributions. Fund 5, as an example, we've been invested for 16 months. It's 60% called and 95% committed. So we will have initially a 20% capital call. So investors that come into the fund will have a 20% invested capital call. Fund 6 is already making investments. We expect the fund to be at least 50% invested, 50, between 12 to 18 months, and to be 75% invested in 2 months. And then we'll still call the remainder of capital in year 3. A very important aspect, after year 1, the fund will start making distributions. Basically, during the investment period, the principal is reinvested and the interest on these loans is distributed. So for year 3 in previous vintages, we already had a distribution yield between 6 to 8%. And then from year 4, the yield is above 10%. And again, we get our valuation is updated quarterly. So despite all the distributions, these bonds are accruing the yield, so we get quarterly updates in the in our valuation. So again, 4-year investment period, and why they reinvest the principal during the investment period? Because there is a meaningful reinvestment risk. When we have these loans yielding 10, 11, 12%. There's a big risk, like you have your capital back, and then where do you put it to yield with a yield on that level? It's very hard to find. So investors basically prefer to have the capital reinvested into the fund so that the multiple of capital grows bigger. Madison has been is looking for a multiple between 1.5 to 1.7. Generally, in these short duration funds, they get to 1.3, 1.4. So here we are aiming towards a bigger multiple. So Mauro, yeah, I think we've covered the main aspects. Not sure if we've got questions.
We got one yesterday from some potential investor related with the fees. And as you mentioned, the fee level is very competitive. If you do the comparison to the big ones, GPs in all of the credit area, but also the 50-50 GP catch-up is quite cheaper than the market standard. So if anybody or anyone needs a deeper explanation on that, we can provide that.
Yeah, good point. Good point. And Mauro, for us, you have in the market and the Chilean market, our investor base in Chile is highly sophisticated, probably the most sophisticated investor base in Latin America, given the experience families and pension funds have been investing in alternatives. So you have these big managers with extensive teams, and they can invest across different markets. You have the Apollos and Ares and Blackstones and so on and so forth. For us, Madison has been very interesting because they are a niche investor, but they are the most institutional manager in that niche. So, and as you mentioned, the terms that we've got with them, I believe are competitive.
Okay, thank you all. Thank you, Guillermo. Let's follow up by email, and I think you and your team are available for any additional video call, direct call from you, or also maybe the big ones. If they need something from Madison directly, we can do that.
Definitely. We have a very close relationship with Madison, so we've had investors visiting them here in New York. They're a block from us. Conversations are always interesting. We want to finish our allocation to clients in a month and a half to 2 months. And why is that? Because the bank wants to keep the $50 million, and we have $100 million to investors. And we are also having conversations with pension funds, life insurance companies in Chile, Colombia, Peru. So we want to close the book in a month and a half to 2 months, so that when we get above $100 million, we can get back to Madison and ask for more. Because the bank doesn't want to shrink its exposure. So in case we get 120 or 150 from investors, then we want to get back to Madison and increase the aggregate allocation that we have. So yeah, like our team here in New York is available for further conversations, and we're really excited. I think the opportunity for interesting stable returns in the coming years with Madison is very unique.
Last one, Guillermo, the feeder fund is available to invest through Pershing accounts in the US?
Yes, Pershing and Cayman.
Pershing and Cayman. Okay.
Yeah.
Great.
Yeah. And in case, Mauro, thinking out loud, not sure fiscally or structurally if there is if it makes sense to create a feeder fund in Chile, just a pass-through vehicle that would invest here. Like, it's something that we could do as well.
Okay, right. Muchas gracias, Guillermo.
Oh, no, gracias a todos. Un día vamos a hacer la presentación en español. Me quedo más confortable acá en inglés, pero un gusto hablar con todos y nos quedamos acá listos para conversaciones y sí, estaremos enfocados en eso en las próximas semanas.
Vale, chao.
Gracias, que esté bien.
Chao.
Buen fin de semana. Chao, chao.